good morning. You're watching the market right here in ET Now, and that's really the big takeaway that the markets are acting upon this time around, or rather this morning. While it is on expected lines, the FOMC has raised rates once again by 25 basis points. But I think the key takeaway for the markets is the hint at a pause in the next meeting. Also, the Fed chair saying that inflation outlook doesn't support a rate cut as of yet, and that the US banking system is sound and resilient. The US might see a mild recession, he says, and the Fed cannot protect the economy from debt default. Also, having said that, they did talk about the banking crisis, saying that they don't see any further contagion impact as of now. But that doesn't seem to be cheering the market, Nikunj, considering it is on expected lines. What the dot plot is indicating, what the action was, I guess the market's already priced this in.
Sometimes no news is good news. That's how markets would look at it. The Fed has given nothing new to the bears and nothing new to the bulls. If you frankly ask me, it is absolutely status quo. The importance of the last Fed meet was very crucial because that came after the roil which happened in the US regional banks. The Fed has come out and stepped in, and the regional banks' collapse has been averted. Crude prices have come down, commodity prices have come down. Fed is saying the obvious, which is that the scope of interest rate hike may be limited and restricted. So the way I look at it, the Fed event from our market standpoint, that it has come and gone. It will not have a damaging impact, if at all. Now, if there is a negative print on the US economy for the world economic growth, I think Fed would be tempted to in fact cut rates. So they've set the tone by saying that we are not considering a rate cut, but they would be data dependent. My sense is that the Fed has absolutely done what markets were expecting it to do, which is increase interest rates, talk about that there is no risk to the US bank, and also acknowledge and indicate that they're nearing the end of the rate cycle. What it will do, growth stocks will stabilize, stocks which essentially are high P stocks, they should start making a comeback, and somewhere down the line, I think IT is getting ready for a bounce.
Yes, that is exactly how we are likely to see the overall situation pan out. But clearly, you've got most of the Asian markets as well, piggybacking on those cues that we saw overnight. The impact of the Fed commentary did precious little on various asset classes. It's the dollar index as well as the 10-year yield. But the other big talking point this morning is going to be crude oil prices. After already we saw the biggest daily percentage declines for both the benchmarks, you also had crude oil prices which fell another 4%. So they've clearly extended those losses from the previous session. This is after that US Federal Reserve has hiked interest rates. Do remember as well, we have been seeing crude oil prices hovering lower for 4 straight days on the trot, and Nikunj, this month alone down 10%.
This I think is the biggest hurrah for us, and the decline in crude prices are a clear indication of what the world believes where demand actually is headed. Now, you may look back and say that contraction in demand is actually bad news for everybody, and it's not that a country like India which will get isolated. But in the near term, when you see such a sharp reversal in crude, will automatically gravitate flows back into India. From a macro standpoint, we would be disproportionate beneficiary when crude has come down. Reserve Bank of India assumptions last time when they spoke were above $85. Crude coming down means your macro, your twin deficits, your fiscal deficit, a lot of imbalances in the economy which were considered to be the red marks, I think they would be addressed. In the short term, apart from the macro, I think OMCs will rally. Tire companies will spike up. Paint companies have to recover. So there is a nice little small trade coming there, typical trade. Oil goes down, airlines go up. Oil goes down, OMCs go up. Oil goes down, tire stocks, they start rolling.
Although on a separate note, we're down one more airline, but we'll talk about that in just a bit.
That's consolidation for the listed guys.
Yeah, we'll talk about that in just a bit. But, one more major development before we take it across to James Knightley and talk about all that's happening across the globe. is the big escalation in the Russia-Ukraine war. And Kremlin is now saying that it was attacked by 2 drones last night, aiming to assassinate President Vladimir Putin. Now, Ukraine has denied any such attempt and says that drone attack was staged by Moscow, saying that no casualties have been reported and President Putin is very much safe. However, Russia now says that it reserves the right to take retaliatory measures wherever and whenever deemed necessary. Meanwhile, the US Secretary of State Antony Blinken has said that we should take all claims made by Kremlin with a large shaker of salt, and there is no way to validate the reports of drones aiming to attack President Putin. Okay, let's talk about all of this. We have James Knightley here on the show with us. James, hi, good evening to you and good morning here from the viewers in India. Good to speak with you. Pretty much across the expected lines, I guess, James. The fact that, the Fed is saying that they don't see a scope of a rate cut just yet, and that the dot plot seems to be indicating that this could very well be the end of rate hikes and the 25 bips hike as well. No surprises for the markets.
Yeah, hi there. No, so not a great deal there for really markets to latch onto at all. I think it did signal that the bar to justify another increase in interest rates is now much higher. So we have got a much more balanced assessment in terms of where we go from here. So yes, I think it does look as though we are now at the peak in terms of US interest rates. But of course, the Fed is very reluctant to signal that they're even contemplating the possibility of rate cuts before the end of this year. Their current dot plot has no change through to the end of this year, with perhaps 75 basis points of cuts for next year. And indeed, Jerome Powell in the press conference again suggested that he thinks that there is a chance for the US to avoid recession, even if his colleagues in general are forecasting something what they might term a mild recession. Where we stand as a bank, we are more cautious. And I think that really reflects the woes in the banking system in the United States. Jerome Powell talked a lot, saying that he found that the stresses are easing in the US banks. Well, that really seems a questionable assumption, given that First Republic failed only a couple of days ago, and we've got some real stress coming through in the US banking stocks after the US markets closed earlier today. So I think that this stresses in the system, they are there, and my fear is that this will lead to a rapid tightening in lending conditions, i.e. banks stepping back in terms of their lending behavior. And that's critical because what makes a struggling business or turns a struggling business into a failed business is when the banks pull back and pull the plug on that company. And that's when unemployment starts to rise. And my fear is that the fallout from the banking stresses we've seen over the last month and a half are going to lead to banks being far more cautious in their lending behavior. And that will be a real headwind to economic growth that could well necessitate the Fed to reverse course and start cutting interest rates before the end of this year is out.
So James, can we make an assumption that sooner than later, whether it is the economy or maybe the US election cycle next year, the Fed actually could cut rates ahead of that?
I think they will. I am very nervous about the US economic outlook. Firstly, as the Fed accepts themselves, interest rate hikes work with a long and varied lag. We're taught at university that often interest rate rises take more than a year to be fully felt. Well, we've got to remember that the first interest rate hike only happened 13 months ago. So we're barely feeling the first few hikes. And of course, there's been 500 basis points, 5 percentage points of increases. So I think there's a lot more pain to be felt for the economy. Secondly, we have indeed got this tightening of lending conditions, which is going to make the pressure on US corporates and households all the greater, especially when you consider the amount of refinancing risk there is in the US economy, particularly surrounding commercial real estate. I think that's a huge concern. And thirdly, of course, we've got the debt ceiling problems. My fear is that the politicians involved are going to really need to have a crisis hit before they would be willing to contemplate agreeing to a deal to raise the debt ceiling. I think that just the personalities involved just aren't conducive to a smooth transition to get this debt ceiling raised without any stress happening. And then fourthly, we've also got to consider that there's perhaps 40 million Americans who could be faced with student loan repayments restarting this year. Remember, as part of the pandemic support program, debt repayments on federal student loan repayments were stopped 3 years ago. Now, there's a lot of legislation going through, or we've got the Supreme Court in the US deliberating on what to do about these student loan payments and also the debt forgiveness plan of Joe Biden. If the Republican-led or Republican-appointed majority within the Supreme Court oppose Biden's initiative, you could have a huge bill hitting the US household sector, 40 million Americans having to find an extra $400 per month to finance their student loans. So I think these are four critical headwinds for the US economy that will slow growth, will lead to rising unemployment, will get inflation lower quickly, and lead to Fed reversal and rate cuts.
Oh, James, really appreciate your time. So, so nice of you that you could accommodate this interview request. All right. Fed is done. Crude is down. Where is the Nifty? Flat. You can use the word flat and say that Nifty is consolidating, but that's healthy. Nifty is now consolidating above 18,000. So the market may look slightly tardy and slightly lazy, but what is important here is that we have added about a good solid 1,200 points. Nobody is talking about the market breakdown. Everybody is now talking about market breakout. The desire to trade long has come back. The desire to buy at higher levels, FOMO, the word which we use, I think that is applicable. The best strategy I continue to maintain in this market is that if you are long, stay long. Don't go short. And I think in mid and small cap stocks, there are still good bargains available. The earnings season has been better than expected. Management commentary has been, at least in the management commentary with the exception of IT, I think is constructive. Crude prices have collapsed. While selectively you do have impact of slowdown in some specific companies, but in general, if you look at the lay of the land, it is time to be more constructive. I think the Nifty may not do anything special for next couple of days, which is perfectly acceptable, which is what you want. But stay bullish, remain bullish, and don't go short. Simple.
Yeah, absolutely. That seems to be the clear messaging, considering we made that difficult climb all the way back to that 18,150 thereabout print. So a steady ship is nothing that you could complain about, although this morning the SGX Nifty is indicating a bit of a red start for us. But what about the global commentary post all that the Fed has done and indicated? Anisha is here with a quick summary of that. Anisha?
Hi, good morning. Well, let me start with the comments coming in from Mohammad El-Erian on what the Fed did. Now, he says that the Fed has indicated and pushed back against early rate cuts. He says that he does not recall in his career when there was so much disparity between what the street was pricing in versus what Fed was saying. But the bottom line is that there is going to be a lot more volatility both in the bond markets as well as equity markets. And that's what he's talking about. Moving on to what Mr. Gundlach has to say, he's a veteran bond investor as well. He says that he sees an increased likelihood of a recession, and he sees that Federal Reserve won't lift interest rates going forward. So this is perhaps the peak as per him. But going forward, he does expect there is going to be a bit of bearish sentiment when it comes to the equity market. So S&P is something that he expects to decline from here on. He says it's consolidated around that 4,300 mark, but his suspicion is that it's likely to head on the lower side. So that's the word coming in from Mr. Gundlach as well. And lastly, a word coming in from Bill Ackman. We have seen the sharp slide in the regional US bank even in the aftermarket hours yesterday, wherein the likes of PacWest, etc. declined as much as 50%. Bill Ackman says that they're running out of time to fix the problem at this point of time. He says, how many more unnecessary bank failures do we need to watch before FDIC, US Treasury and the government would wake up? He believes that the answer to all of this is a system-wide deposit guarantee regime. But for now, we are seeing a lot of volatility when it comes to the US regional banks.
All right. Thanks very much, Anisha, for putting that into perspective. So those aren't comments to be taken lightly with respect to what Bill Ackman as well has had to say regarding the fact that as of now, looking at unnecessary bank failures that need to be looked at fairly closely. All right, let's bring on board then our chartists and find out what the markets are spelling out for us this morning and levels to track as well as top stock recommendations. We've got Naresh Mirani joining in as well as Kunal Bothra. Morning to both of you gentlemen. And Naresh, let's get in a flavor. Well, we're sensing that right now maybe a flattish mood is the order of the day, but that is not necessarily going to be bad news and is going to be fairly welcome given all that's transpired across the globe.
So we've gone up well from 16,800 to 18,100, 18,200 levels. The last major highs are also around this price point. So a little bit of a pause in this area would be a good consolidation for the next leg of the move. So for now, 17,800 becomes a base, 18,200 becomes a resistance. And once we pass some time here consolidating, then it can be a move towards 18,600, 18,800. So overall, the trend is still positive. In this period, I would expect more stock-specific action. The index heavyweights could take a pause, but the selective moves which have been happening in the broader markets should continue. Bank Nifty also at 43,000 to 44,000 zone is a consolidation zone. 44,000 roughly is the previous high. So tough to take it out in the first attempt itself. So a pause here in this band of 17,800, 18,200 should be taken as a time to be more stock specific rather than index specific.
All right, Kunal, let's get in your take on the markets. Yesterday, we slipped below that 18,100 mark. It had been a commendable feat that we managed to conquer that. What's in store for us now? What's happening to the Nifty Bank Index?
Good morning, Avan. So, we were flagging off 2 days back that how the indices have come back towards a major resistance zone, both on the Nifty as well as on the Bank Nifty. I think we are now looking at a pause, which could be a slight bit more extended for the indices. I was actually expecting maybe 2 days or 3 days of consolidation. But looking at the setup of the markets across the globe as well as for our markets, I think the setup may just, the consolidation may just extend itself for a few more trading sessions for the indices. But then I think that should ideally be a good opportunity for traders who missed out on the index trades earlier. So, for example, from the Bank Nifty perspective, 43,500 odd levels is where, we initiated to book profits. I believe now, possibly if the index corrects back below the 43,000 mark, say comes closer to 42,800 odd levels, that could be a point where traders could look to initiate a fresh buy. There is hardly any change in the open interest in terms of yesterday's data. And that was a bit of a surprise because even after yesterday's downtick on the indices, marginal downtick on the indices, I was actually expecting that maybe there could be some bit of long unwinding, which could probably creep in into the indices. But there was just hardly any kind of change in the open interest data, just 0.2%, 0.5% change in the open interest for the indices Nifty and Bank Nifty. That itself tells you that traders are also on a wait and watch mode for the indices and not tweaking too much of their position. So looking at the stance, would maintain a consolidation stance on the indices and the action to be more towards the mid caps and small caps.
Okay, and since Kunal and Naresh both feel that the index is only going to consolidate, let's look outside the index and let's talk about individual stocks then. Naresh, what's on your list?
So first is a buy on Tata Motors. The stock has been slowly and steadily trending up after that big breakout move of 450 levels. Continues to show momentum out here, expecting a move towards the previous 52-week highs and the major say resistance area of that 540 zone. Stop loss to be kept at 470. Second is a buy on NTPC, a defensive stock which is again bouncing back from that 170 area. 180, 82 remains a resistance. Out here, we've seen a lot of PSC names do really well. This is the only one which is still lagging behind. I would expect a catch up here. The stock has made a good enough sideways consolidation in this band. Yesterday was a dash towards 178, nearing a short-term trendline breakout. So expecting a move into new all-time highs. A stop loss at 170 and a target price of 200.
Okay, and Kunal, what's on your stock-specific list?
So I'm going with some offbeat stocks. The first one is from the OMC pack, the likes of IOC, which I believe looks very attractive. Crude falling as well looks to be a more of an added advantage to the stock price trend over the near term. The trends have been also very bullish for the other two names from the OMC pack. I'm picking up IOC as of now, targets of 86, stop loss to be kept at 80. And the second stock was one of the recommendations which I flagged off yesterday, the buy on HSCL, Himadri Specialty Chemicals. Again, a classical breakout. The stock went up to almost 115.16 mark, closed at its day's high. Looks very attractive as a chart, so would maintain the target of 120. Traders could look at a fresh buy at current levels. Stop loss to be kept at 113.5.
All right, there you have it, all your fresh stock recommendations from our chartists. In the meantime, let's hear it out from Sridhar Sivaram, Investment Director at Inam Holdings. He remains overweight on financials, saying that banks are in a sweet spot right now.
There's a big difference between US banks and Indian banks, that we've always seen a very high rate. And if you just look at, say, mortgage as an example, barring the two COVID period when the mortgage rates actually fell to 6.5%, we've broadly been in the 8 to 9% range of mortgage for a very long time. The last time the mortgage rate fell below 7% or closer to 7% was in 2001. So actually we're used to a higher rate. So I think maybe the people who borrowed at 6.5, now that the mortgage rates have gone to say 8.5, they may have some issues. But even there, we think that tenure gets extended to some extent. So we don't see a big issue as far as financials are concerned. We are actually very bullish because in the last 5 years, all banks have cleaned up their balance sheet so well. Most banks have extra provision cover. Due to COVID, they had kept COVID provisions. And if you look at the financial numbers, I think the NPA numbers are far lower than what most banks had guided. So we think we are in a sweet spot right now, but it has to be watched carefully. As you mentioned, one of the corporates had issues yesterday. So you have to just watch the space carefully. We are quite bullish. We are overweight on financials.
Back with the market right here in 80 now, the SGX Nifty indicating just a mildly negative start, just a little bit soft around that 18,100 mark after dipping below that level on the Nifty spot in yesterday's trading session. This morning, besides of course a completely unpredictable lines, Fed action, you've also got a whole host of numbers and internal factors as well that the markets are going to be reacting upon. Titan posted its Q4 numbers where the margins and net profits have missed the street estimates. In fact, the company's jewelry and watch business clocked in good growth this quarter as well. Vinny is here to tell us all about the numbers. Vinny?
Absolutely. So in terms of numbers, you see a miss is coming in on the margin front. Revenue was above the expectations. Revenue grew by 33%. While in terms of the EBITDA margins of the company, that have seen a contraction coming in. We were expecting EBITDA margins at 12%. They've come in at just 10.7%, approximately around those levels. On a year-on-year basis, EBITDA margins have remained flat. Profits of the company also have seen a growth coming in. Now, jewelry segment, which accounts to more than 80% of their revenue in terms of the mix, that has seen a growth of 32%. And also do not forget, there's around 1,000 crore in terms of bullion sales, which is included in the jewelry segment as well. So jewelry segment has seen a growth of around 32 to 33%. Watches segment, eyewear segment have seen a very strong growth as well as the emerging businesses that have also seen a good growth coming in. Now, overall, when you look at it in the jewelry segment, also what you're seeing, the market share of the company is at around 7%. 8% is now digitally influenced in terms of sales for the jewelry business as well. Studded ratio is coming in. The studded jewelry sales are at around 33% of the total sales of the jewelry segment. Other than that, the management is also highlighting in terms of commentary coming in for the demand. March, yes, subdued demand is what they mentioned. April, first half was also subdued demand. But from the second half of April, we have started and seen an improvement in terms of the demand trends is what the company is highlighting. Obviously, in March and April, there was a lot of gold price volatility which impacted the company. So keep an eye out on that. And company is also highlighting that they have continue to remain quite well placed in terms of the months of May and June as well in terms of demand for the jewelry segment as well. Management is also highlighting that jewelry EBIT margin, which is at 13.7% right now. They believe that the jewelry EBIT margin for FY24 could be somewhere in the range of 12.5 to 13% as well. So those are the key highlights that are coming in from the management in terms of Titan's commentary. Also, when you look at brokerages, now JP Morgan is continuing to stay overweight on the stock as well as of now. Other than that, even CLSA said that seems like it was a good performance in Q4 FY23 from the company. They're maintaining a buy on Titan and they've increased the target price to 3,210 rupees per share. Jefferies, they believe that all the good news is actually priced in for Titan, so they are retaining their hold rating for Titan. So that's the update that we're getting in terms of the review as well as the brokerage notes this morning.
Thanks for that, Vinny. And yes, that's the management joining in just a bit from now. But let's move on then. ABB India came out with a healthy set of numbers for Q1 CY23. What has really aided that growth? How has been the overall margin performance? Let's find out from Lisa, who's tracking the company. Morning, Lisa.
Absolutely. ABB India has reported stellar set of numbers, beating expectations on all fronts. Let's see how the numbers are stacked versus the expectations. The revenue that came in 4% above the expectations. Also the EBITDA that was 15% above expectations, and also the margin that was higher at 11.8% versus the 10.7% expected. Talking about the performance on year-on-year basis, revenue and EBITDA that grew in double-digit basis. Revenue growth was seen across all the segments, the process automation, motion, as well as the robotics. And also the margin improvement that was on the back of better capacity utilization, volume mix, and also better pricing. But the PAT, that saw a decline of around 34%. But do remember that last year there was an exceptional gain of around 293 crore on the back of a sale of their turbocharger business. So adjusting for that, PAT actually was higher 60% on year-on-year basis. Now talking about the orders, order inflow that grew at around 36% year-on-year, and in fact that was the highest ever. The Q1 order growth that was the highest in the last 5 quarters. Now the con call that is scheduled for tomorrow, and the important commentary to watch out for would be the volume, the order outlook for both the export as well as the domestic, and also they have planned capex to focus on the export. So what is the status on that? And also they have a strong cash balance of around 3,900 crores. So what are they going for? Are they going to go for the capex as well as acquisition, and of course FY24 guidance that will be also in focus. So well, ABB is in focus on the back of strong set of numbers reported.
Right. Okay, we'll leave it at that. In fact, Aavas Financiers, that's the one which is in focus this morning. They've reported their Q4 numbers. Besides that, there are a couple of top-level resignations as well. Sushil Kumar Agarwal, the former MD of the company, may weigh on the stock. Why is that? Vamakshi is here with all the details.
Well, let's first start off with Aavas Financiers results. When we look at the net interest income, that saw an uptick of almost 23% on a year-on-year basis, while pre-provisioning operating profit saw a growth of nearly 22% year-on-year. PAT, however, came in higher by 10% on a year-on-year basis. Provision cover has increased for the counter from 3.5 crores to 6.4 crores. When we look at the AUM disbursement growth, that has been, however, quite healthy. Fourth quarter disbursements stood at 1,500 crores, an uptick of almost 25% on a quarter-on-quarter basis. So that is a good growth coming in as far as disbursements are concerned. But the AUM number at 14,100 crores is also quite strong, with a growth of 8% sequentially and 24% on a year-on-year basis. The company also added new branches, so that is again a bit of a positive. And the asset quality overall for this counter has improved. Gross stage 3 assets have declined from 1.13% to 0.92%. Now, apart from that, another important factor that will keep Aavas Financiers in focus today is the resignation of the top management. Mr. Sushil Kumar Agarwal resigned from the position of MD with effect from May 3rd, and in his place, Mr. Sachinder Bhinder has been appointed for a tenure of 5 years. Now, Mr. Bhinder is currently the CEO of the company, and he has now been elevated to the MD of the company. Now, earlier in April, we saw that the latest shareholding disclosures revealed that Mr. Agarwal has actually pulled down his stake in the company from around 3.33% to 1.5%, which is a reduction of nearly 1.8% stake. And Citi at that point in time had in fact come out with a note, and they believed that the sell down could temporarily weigh on the stock, and in fact they actually closed the upside 90-day catalyst watch that they had. So largely the resignation development is negative. Mr. Agarwal was instrumental in designing the business framework for Aavas since its inception, and in fact the reason behind the same would be important to know as the core team at Aavas was sticky for quite some time. So results and the resignation of MD, which is a bit of a negative factor, is the reason why Aavas Financiers is in focus today.
Yes, indeed, this is going to be an overhang on the stock. Thanks very much, Vamakshi, for giving us those details. Top fundamental stock ideas then. Let's hear it out from Dipan Mehta. He's positive on the capital goods space. Which stocks does he like? Find out.
I think Cummins is in a very interesting space. We have been very positive on the entire engineering capital goods space, and Cummins, I think, is one of the leading engineering companies. I think its gensets and diesel engines, diesel gensets are absolutely world class. and of course they have the advantage of exporting to other Cummins subsidiaries as well on a transfer pricing basis. Valuations are reasonable compared to historically what the stock has traded at. And I think after many quarters of sideways to slightly disappointing performance, last 2 quarters, at least last quarter and this quarter, may be quite impressive. A lot of the cost increases, I think, have been passed on, and now we are seeing subdued raw material trends, and that should benefit the margin management for the company. And the way we are seeing infrastructure projects take off, I think there's going to be good demand for the company's products as well. So very positive on Cummins per se, and it's a premium player, MNC company, and always has traded at a very high price to earnings multiple. So let's not get too impacted by that. But on the whole, I think next few quarters look very interesting and very positive for Cummins.
All right, Chakri Lokbre joins us now. Chakri, good morning. Thank you for joining us. We've seen a 1,000-point rally on the Nifty. Do you think more is coming? Are we in for more gains in the month of May? Or are you looking at selling and going away?
Good morning. I think, to put it in context, yesterday's Fed move, on a total about 500 basis points has been increased by the Fed in a space of about 13 months, in about a year's time. This is the largest, biggest rate hike ever. So which means this is going to put strain on the US banking system, slow it down, which is, I guess, they wanted, which is going to put some amount of pressure on Indian exports. But the services sector of Indian companies, is at a 14-year high. So which means therefore all the services related companies are on a strong wicket as far as the stock price outlook is concerned. So despite all this weakness of yesterday of the Fed, I think IT looks strong, banking looks strong, and capital goods look strong. Consumer, because of input prices are coming down, and there is some amount of volume coming back. So consumer discretionary, capital goods, and banking.
Consumer discretionary, capital goods, and banking. Why consumer discretionary?
Now, if you look at a company like, for instance, small ticket consumer discretionary like Devyani, Jubilant Foods, all these companies have corrected significantly over the last 12 months because of falling volume, high input costs. That is reversing now. And many of the volumes are coming back. Input costs are down about 15-20%. The multiples, while optically high, the earnings growth is out there. So, going into summer, these kind of companies benefit holidays, the school holidays, summer vacations, etc. And so I think so therefore, the small ticket consumer discretionary goods look good. On the other hand, Titan, which is a high ticket value item, also looks good because of its inherent business model, where it is in terms of gold demand, jewelry demand remains strong, and its related new products, which it's venturing into.
Chakri, ABB India has reported extremely a robust quarter. The revenue margins have all risen. It's a healthy order inflow as well that they are seeing, and a very robust cash position as well that they've clocked for, this calendar year first quarter. But is the best already baked in the price when it comes to some of these cap goods majors? Because they've been the market flavor for quite some time now.
ABB in particular has a phenomenally strong new product development outlook, not just in the Indian arm, but also in its overseas arm. And so that lends extremely well to the Indian arm in terms of its ability to offer new product ranges and also to be able to cater to its own export out of India. So while the multiple is high, I think the order book will continue to strengthen despite global weakness, etc. So a combination of what's happening within India and its export order book, I think ABB still looks very good.
Okay, moving on then, we've also got some critical numbers that will be coming out later today. And Chakri, wanted to get in your thoughts in particular as to what you're expecting from Dabur in terms of their volume growth. What do you think the street wants to hear by way of commentary as well?
I think Dabur, it's that which is basically I think the street is expecting to see some amount of reduction in input costs and therefore helping margins. But the margin outlook is unlikely to improve significantly because the price competition is still out there. And therefore, as long as they maintain margins and a reduction in input costs, I think Dabur will.
That's the take coming in on what to expect from Dabur. The other big development, of course, this morning is Aavas Financiers. And, we just told you about it's not really the earnings, it's more the resignations that are, that's what the market is going to be focusing in on. The fact that there have been top management changes. Sushil Kumar Agarwal has resigned as the MD. From May 3rd, Sachin Bhinder has been appointed as the new MD, and he, remember, is the current CEO. He's been appointed, of course, for the next 5 years. Chakri, I'm not quite sure as to, how closely you've been monitoring the developments, or for that matter, Aavas Financiers. But if you are, what's your take on this?
Actually, I think you summed it up perfectly right. Because of the departure of the new CEO, there is going to be some amount of uncertainty because he's been around for the longest time from when the company started. And and it's not a cheap stock. Yes, the fundamentals are kind of holding on well. It's not a cheap stock. So I think it's best to wait to learn what is going to happen and be on the sidelines.
Right. Okay, that's the take coming in on Aavas. In the meantime, Titan, of course, we're going to be chatting as well with the management later on in the show. Just to put it into perspective as to how skewed the street is in terms of an overweight stance on Titan. So Morgan Stanley, for instance, they've got an overweight rating with a target price of 3,003. Jefferies, they've called it a hold after its earnings. 2550 is the price target that they have been putting on, although it's much lower than the current market price. So I think there's a bit of a correction there. It should be 2650 perhaps. 2654 is actually where we shut shop, so even that has been achieved. Morgan Stanley is saying that, they're overweight. The Q4 earnings, they're saying, are broadly in line with estimates. Emerging businesses are going to continue to grow well. Buy growth and high bill values have been aiding the jewelry business. That's what Jeffrey's view is. And they're saying that segmental margins, however, have been a little bit off a miss. Chakri, the one trend that we've been picking up here on ET Now is the urban consumption, which, be it high-ticket jewelry, for instance, that's been aiding the margins for Titan, or for that matter, cars, be it, the kind of ARRs that some of the, hotel segments have been clocking off late. Just wanted to understand where within urban consumption are you still overweight, and where is it that you believe one could add fresh positions?
In the urban consumption, all these small ticket discretionary items, whether if you look at, for instance, Titan looks very good. The valuation is fairly high, but it's, jewelry as a business is doing really well. And in an environment where generally inflation is high and white goods in general are, have their waiting times, etc., higher, lower discounts is impacting. Gold works, jewelry works in a slightly different way, a combination of both. Is not just a discretionary purchase, but also a savings instrument for the client, for the customer. So therefore, that business will do well as a stock. Second, some of these stocks, like I mentioned earlier, Devyani, Jubilant, they've all corrected. You also look at a Crompton Consumer, for instance. Same story. Because of well-known concerns, the stock has corrected. It's trading at its trough multiples. And again, some amount of demand for its usual electrical goods adjusted for the multiple will come back. So these are the items, the kind of companies that we're focusing on.
Right, let's move right on then and keep a sense as to what are some of the stocks that are on the editor's radar today. Well, we're zeroing on those tire stocks. What a phenomenal run we witnessed in trade yesterday. And I think, Nikunj, a large part of that could be attributed to the fact that crude oil prices have slumped significantly.
Crude and rubber both.
Yeah.
For tire stocks, raw material, which is a combination of crude and rubber. Now, why crude? Where is crude and tire? Carbon black. Mm-hmm. It's a derivative of oil, which essentially is being used by the tire industry. So that's a derivative of oil, which is important. Crude goes down, tire stocks, they go up. But more importantly, now that's how the margins are likely to expand. More importantly, I think there is a normalization which will be at play. Industrial capex has started, cars are selling, semiconductor and chip shortage are behind us. Auto companies are ordering, tire companies are telling their OEMs that, look, I think things are normalizing. This would be a normal year for tire companies. And I think within that, if you are looking at companies which have a large bent towards passenger car and less towards commercial vehicle, I think that play really would be at play. While tire stocks yesterday did move up, I think they have a long way to catch up, both in terms of what the near-term trigger would be and also which way the demand scenario is moving for them.
Okay, so clearly that's going to be a key trigger and a catalyst for those tire stocks. They were on fire in trade yesterday, but today let's focus in on another stock that's going to be in the spotlight, and that's largely on the back of earnings. You've got those paint stocks as well, by the way, that are on the radar, and that Nikunj is largely also a crude related thing, right?
Yeah, so tire, I think tire paint, they become like an assembly line, right?
Yeah.
But I think we've got Chola there.
Yeah.
And why do we have Chola?
Healthy set of numbers that the company delivered.
Yeah. So, Avan, when interest rates, they go higher, NBFCs, they underperform. When interest rates, they start peaking out, a quality franchise like Chola will always do well. Globally, interest rates have peaked out. Locally, Reserve Bank of India has stuck the pause button. Post the crude collapse, I mean, Shaktikanta Das must be the happiest guy because his forecast is actually going right in terms of where inflation is moving. But his forecast is going to help a stock like Chola. And the logic is very simple that when you are in NBFC, you're borrowing from the wholesale market, and the wholesale market rates are always higher in a rising interest rate environment. NBFCs, they tend to do well when the economy is doing well and when interest rates are benign. So we are there. The economy is strong, interest rates are benign. Chola has a large component which comes from CV space. It's an expensive stock, but I think when typically you are at a turn, when NBFCs are looking to make a comeback, I think both Bajaj Finance and Chola, after a little bit of underperformance, I think they're ready. It's like, like before a 100-meter dash, you say, get, set, go. I think that get set is ready. The go button has been pressed after Reserve Bank of India's pause button.
Yeah, and even JP Morgan is giving it a solid thumbs up. It's an overweight rating that the stock has been upgraded to. Disbursement growth as well.
Underweight has become overweight. Yeah. Just imagine.
So really ready to get, set, go. So Aisha, lots of stocks as well that we'll be discussing with our guests, but these are the stocks on the editor's radar.
Oh yeah, absolutely. And that's quite an upgrade coming in case of Chola, almost a re-rating candidate. But as 5G rollout gears up in India, my colleague Aishwarya Patil caught up with Bharti Airtel CEO Gopal Vittal. Here are what he had to say.
We are now in about 3,500 cities. We are rolling out almost 40 cities a day. So it's a very, very manic pace of rollout that is happening. Our capex that we've always indicated, over a 3-year period is more or less in line with what we normally spend. There may be some advancing of capex in a given year, which is the rollout year, but if you take a 3-year view, it will be around the same level.
Two-part question. One is that 5G tariffs are largely, there's no tariff hike that you've done for 5G. Is that sustainable? And globally, India's tariff is one of the lowest in terms of 5G. Is that a sustainable level at this point, and will we see some hike coming in, or will it be just, according to user data?
Yeah. No, I don't subscribe to the view that 5G must have a different pricing, because if you price something differently, then out of 100 users, maybe 10, 12 will take it, which means your overall revenue doesn't go up. But I do subscribe to the view that the ARPU of the industry needs to go up. Today, the return on capital that the industry gets is 8%, which is as much as you would get in putting your money into a fixed deposit. So why take all of this risk? So you need greater financial health of the industry because there's a lot of capital going into it. The only way that will happen is ARPU goes up. Today, India is the lowest in terms of rate per GB as well as ARPU anywhere in the world, even compared to sub-Saharan Africa. So yes, ARPU needs to go up. It's not in our hands. We do what we can, but the industry needs to raise.
Follow-up question, last one. What is a sustainable level of ARPU to your mind?
Well, we've always said that we would like it to be close to 200 in the short term, which we are almost there. We were 193, about 190 rupees last quarter, and then ultimately get to 300 rupees, which is really a sustainable level for the industry. It's still much lower than anywhere else in the world. Still much lower than anywhere else in the world.
Chakri, 5 years ago, Airtel said, ARPUs are lowest in the industry and the lowest in the world. And after 5 years also, they say the same thing. Where nobody is stopping them from increasing them, right? It's just that they can't increase it. If they can't increase it, why should markets buy the stock?
No, indeed, the problem with the sector is partly their own making and partly also some amount of politics, consumer price controls, which has impacted their ability to increase prices. And even in the current commentary, coming up with absolute numbers, whether it's 300 as a sustainable number. Why is it 300? It should be a cost of equity plus at least a certain amount of return over that. So I think that is what undid Vodafone. And I think that problem continues with this industry. So pricing power is something which they absolutely don't lack, unlike any other country, big market that is. So I think, and capex intensive, all well-known facts. The stock has had a good run. So I think the incremental monies, I wouldn't really commit to the telecom sector.
Bharti's been consolidating around that 770, 780 kind of level for a while now. Kunal, do you see any upside anytime soon? Naresh.
So Bharti has been in this zone for quite some time. Gave a short-term breakout, did not make a large move, was expecting a much bigger move here. But the stock continues to be say in that same band for quite some time. I would be waiting for it to cross 800 levels, and then maybe again it should be a fresh momentum trade. Gave a breakout about 775, went up to 800. In the last 2 days, has again come back. So for now, 770 is a stop loss. It's a buy at current levels as a risk reward trade. And once it sustains 800, we could go back to 860 also. Over the last 3 months, it has made 4 to 5 bottoms around 740 to 750. So the base is set, but the momentum is not as great as I would have expected after that breakout. But would keep a stop loss at 770 and still would be a buy at current levels.
Okay, that's the take coming in on Bharti right now. Let's also look at some of the other buzzers yesterday. We were talking about as to how the aviation industry is consolidating now, what's happening with Go First. So look at the spike up coming in on Interglobe Aviation, which in any case has the most dominant market share in the Indian skies. And of course, there's that crude benefit as well playing out. That stock held out by 4.6% in trade yesterday. Indigo will come up for you on your screens. We were just chatting about as to how tire stocks as well stand to benefit. The entire spate of the, crude beneficiaries here. So MRF as well held out very, very smartly in trade yesterday, a 6% spike up coming in there. And then, of course, there were others like Loris Labs, Hindustan Aeronautics, BHEL, which were some of the other buzzers in trade. Chakri, quite a bit of decline when it comes to crude. Just wanted to understand whether in the very near term you would be tempted to, go long on any of the crude sensitives.
Indeed, whether it's tires, all these companies do benefit, even cement for that matter. Petcoke prices are also somehow linked. Are clear beneficiaries in this environment. And because of the overall confusion over the degree of weakness that will be in the US because of the Fed hike, the oil prices have moved lower. So it's a input price. The only thing is one needs to watch out for is whether the export demand of all these companies will come down if it translates into global weakness because of the interest rate hike. But if you look at Apollo Tires, CEAT, MRF, of course, is a slightly pricey stock. It's always been a pricey stock. Apollo Tires, CEAT, JK Tires, these are all extremely low valuation companies. Volumes are coming back. So clearly, yes, crude beneficiaries is something which we have been buying.
Okay. Naresh, let's address the Nifty once again. We have addressed it, but let's revisit it. Is Nifty getting slightly tardy and slightly, is slightly exhausted now? Do you think we're going to spend some time, maybe a few days, 10, 15 days, rest of the May in this range of 18,000 and thereabouts?
So whether it is 10, 15 days or 5 days is a tough call. But yes, so if you look at the last time when we touched 17,800, 850 levels, there were 5 drifting lower sessions and then we recovered. So there was roughly around 5 to 8 sessions after which we could cross 17,800. So something like 5 to 10 trading sessions, couple of weeks would be normal, wherein we get into a new band which would be 17,850 to 18,200. And yes, it's a little overbought given that we've moved up to 1,200 points. And the fact is, say, the Bank Nifty, which is the largest weight, is almost just 2% away from an all-time high. So in the leading, say, sector, also has a little bit of a pause here in the major resistance zone. So yes, expecting some bit of consolidation in the Nifty. It could maybe last 5 to 10 trading sessions, not necessarily the whole of May. But in that period also, we'll see broader markets to do well.
The take coming in on the Nifty right now. A couple of other names. Manappuram, that cracked pretty hard in trade yesterday. Let's just bring up the intraday graph of Manappuram Finance, and that's quite a bit of crack that came by in trade yesterday. Of course, there were news reports that the ED has been conducting some raids at their premises in Kerala, and I think the MD's residence as well. Quite a bit of crack coming in there, 12 odd % or so. But overall, Kunal, considering you do track the charts of gold and all these gold lenders, Manappuram, Muthoot, etc., how are they looking?
So, both the charts, Manappuram and Muthoot Finance, I think till day before yesterday, they were looking quite stable for themselves because, Manappuram Finance recovered quite well in the last few months. I think, the low the stock had hit in the month of 2022 was almost 82, 84 rupees. And from there, the stock recovered to almost 132, 135 levels till, last week or so. So the recovery was quite strong for Manappuram Finance. And there was probably a sense that the stock may get into a restarting mode in terms of the long-term trends. So I think I'm not sure how critical the data point is yesterday, but yeah, in terms of the price damage, it was significant for Manappuram. So my sense is that the stock would take some bit of more time to maybe come back about that 130 odd mark. So now we are in for more of a time-wise correction for these gold finance names. Even the likes of Muthoot Finance, for example, that stock was actually an underperformer because when you try and compare the lows of the stocks like Manappuram and Muthoot Finance, Manappuram formed a bottom first, managed to rally, show signs of leadership. Muthoot Finance was one of the late stocks to form a bottom and then start to pick up pace. So I think there's a bit of a lag which is there in the charts for Muthoot Finance, and that may probably dent the prospects for the near-term way. So I would probably sense that we are now in for a more of a time-wise drift for these gold finance names. But on the other hand, the charts for gold, both in terms of dollar, in terms of rupee charts, are just into a different tangent altogether. We've seen very strong breakouts happening on multiple time scales for these asset classes. And I would probably sense that we are in for a trend which would last for at least another 6 months to 9 months for gold as an asset class.
Let's go back to Tata Motors. Chakri, you didn't like it. Kunal liked it.
Yeah, I think Tata Motors looks
JLR
good.
is doing well now. Suddenly, see, cash flows are coming.
Yeah, cash flows are coming. Yes, indeed, and the China is regrowing. All the good things are happening. JLR high margin businesses coming back. Their EV range within the JLR is also a good portfolio of products. They will be cash flow positive in about a couple of years. And the valuations was never a concern. It was just the amount of debt and the demand because of various China-related slowdown issues. But the news flow, fundamental news flow around the stock will be very volatile given its export business. But if you can withstand that, I think clearly it's a good stock.
Kunal, what potentially should one do for those? And I think I'll like to speak a disclosure on behalf of Kunal that Kunal has invested in Tata Motors. With that disclosure on Kunal's behalf, Kunal, what would you do with your position? Why don't you walk us through it? I mean, at what point you would be saying that, look, I'm going to book profits?
No, I think I would not be in a hurry, Nikunj, and especially after what happened to Tata Motors over the last 1 year. Because, when stocks move up 5x, 6x in a span of just about 2, 3, 1 year, 1.5 odd year, like what we saw for Tata Motors from levels of, I think, 64, 66, which was the low for the stock in 2020, to a point where the stock was almost at 520 odd levels. Now, when you see such a kind of a steep run, you expect the stock to get into a time-wise correction. Now, the beauty about the chart, which I like for Tata Motors, even in the last 1 year of consolidation, was 3 attempts where the stock managed to break below the 400 mark. And all of those 3 attempts managed to halt at almost a 375 mark. 375 or 380 was the low for Tata Motors. It consistently tried to break those levels but failed to do it, which means after a steep rally of this 8x, 9x for Tata Motors, you saw 1.5 years of time-wise correction, unable to break below major support. And what we're seeing right now is the first month, or rather the month of April, is where the stock had managed to show signs of a breakout yet again. So what we are now looking out for is more of at least another 9 months to 10 months of rally for Tata Motors. Hopefully, that rally should probably take the stock back towards maybe 600, 650 odd mark for Tata Motors. That could be a point where we may look to sort of anticipate and go into some sort of profit booking mode. But before that, I would not be in a mood to book any kind of profits over here.
Rish, a similar question for you for your position in Indian hotels, since you've been talking about it on a daily basis. Now, at some point in time, all investing, I mean, at some point in time, you would like to lock your gains. Is that level of 360, which is where I think the stock is that level a decent level for a long-term positional investment of yours to be cashed out?
So continue to remain on the whole hotels space apart from Indian hotels as well. So my view is if a sector comes out of a 15-year, say, a period of zero return for almost 12 to 15 years, it tends to surprise over the next 2 years. So I would wait for, say, some more time, ride it on. And the best way to play such trends is to keep a trailing stop loss. So recently also got a fresh trade at 335 to 340. Again, it is riding onto the same move. So the view is once something comes out of a 12 to 15 year, tends to surprise. So we've seen that happen with the Hindustan Unilever, where nothing happened for 10 years, then did really well for the next 5. We saw it happening with Reliance Industries, 8 to 10 years of no returns, and then it continues. So not keeping a price target, but keeping a target when to get off. So on the way down, maybe we'll be able to get down 10-15% lower from the top, but till that point of time, you want to keep riding because uptrends can surprise in such long-term breakouts.
All right, just a quick check-in on the pre-open rates, and at around 18,064 after the street seems to have digested the Fed move overnight, and for now you've got the Sensex, which is still holding out in the green. Let's find out what those mid-cap strategies are from our chartists then. And Kunal, what's looking good on the charts today?
So I flagged off a stock like Action Construction yesterday. That stock looks extremely strong on the charts. In fact, it's come out of a major consolidation breakout, breaking past about the levels of 425, 430 yesterday. So keeping 431 as a stop loss would suggest a buy and carry on the trade from yesterday. 455 could be a revised target for Action Construction.
Action Construction it is, continues to get a thumbs up on the charts. Meantime, Naresh, let's discuss your top mid-cap idea.
So that would be a buy on United Spirits. The stock has been consolidating, making a very flattish range formation. The high around 795 to 800 has been tested 3-4 times. Yesterday also came to those levels and pulled back a bit. Expecting it to break out soon. The risk reward trade here at 785 levels. A stop loss at 770 and a target price of 850.
Is there merit in buying liquor stocks, and is there merit in revisiting some of the liquor stocks? Now, for the quarter gone by, things weren't great for liquor stocks. At least United Spirits numbers were not great. United Breweries for the longest time has struggled because of high barley prices, high glass prices, high transportation prices. United Spirits is owned by Diageo. United Breweries now is almost owned by Heineken. United Breweries has beer, United Spirits as the liquor, the hard liquor, if I may say so, largely dependent on whiskey. United Breweries, and let's look at the stocks here. I mean, from last 2 years, a lot of promise, but every time the stock has gone to 940, 950, United Spirits just comes down. Similarly, United Breweries, I mean, the logic is that India is a warm country, the beer consumption will continue to grow, but none of these stocks really have given you great returns. And Chakri, I just come back to the whole point here. I mean, why a stock like United Breweries, which is a complete play on urban consumption, urbanization, hot summer, more refrigeration, and IPL cricket matches. Everything is happening, but United Breweries as a stock is not doing well.
Some of those factors that you mentioned, which is, high input costs, high glass prices, all those things have held back margins. Lately, in terms of beer, there has been a certain amount of shortage of the demand has been strong in terms of the production. But and all those urban factors included and sport venues, all those things. Unfortunately, in our country, because when social issues, moral issues, etc., are put forth, that holds back, that changes that story a little bit. I think, therefore, from an Indian context, we have to view these stocks slightly differently. uh, from the urban consumption increasing. And second, it is from what companies say is where people tend to have more alcohol than beer because they get a better high for the same price, and therefore beer volumes are also holding.
Crude, let you go. Thanks so much for sharing with us your thoughts on the markets.